Okay, we've got your highest conviction ideas. Let's get into it in Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get into your Pro Picks. These are 3 high-conviction ideas that you own in the portfolio. The first one is WSP Global, Canadian engineering and consulting firm, and I don't feel like it's definitely not a household name. Canadian investors know about it, but I don't know that it gets the credit that it deserves from becoming this like little Montreal engineering consulting firm to this multi-billion-dollar global company in a very short period of time.
Yeah, I think it's an interesting story because in its early days, I mean, it had some accounting things and it was a small company, and small companies tend to have a little bit harder time kind of writing the financials and getting everything out. But then it started to develop and change its name to WSP Global. And it's a platform company that buys other engineering consulting firms. So one of the advantages to doing that is that you can get scale. If a client comes to you to do work on pipes, well, we also do work on these types of pipes, and we do work on nuclear. We do work on all these other categories. So there's synergies from having all of these different types of consulting under one roof. And it's also an industry where a small consulting firm can do very well with maybe 10 or 12 engineers, but they can't necessarily make the leap in management to become a 50 or 100-person engineering firm. So it's an opportunity to, again, buy private, where you can buy these engineering consulting firms private and get a public valuation and also get some diversification of your product lines and of your consulting business. So it took a lot of consulting companies took a bit of a step back as the Musk chainsaw fell on government spending. But what we're finding is that long term, if you want to build something and infrastructure build out is a real phenomenon globally, you need engineers. You need engineering consulting. So it's still a nice business that's growing at a relatively decent clip. And they're able to go and buy companies, and usually when they buy, it's accretive to earnings. There tends to be a period where it sort of slows a little bit right after a bigger acquisition. And now we're into a position where they're likely to grow faster than I think the market expects. And that's really what we go for. It does better than its industrial peers. It hasn't done as well as the TSX. And over the last year, it's only up 3%. Yes. And obviously, if you were only picking not popular names, then we would have nothing to pick. I mean, this brings me back, and we kind of use a particular approach when we're thinking about stocks. So how do you find something that's undervalued? And what I call the roll forward is important. So if I look at earnings 2 years out, what am I paying for those earnings? So if I'm paying, for example, 12 times earnings 2 years from now, and I know that the stock typically trades at 14 times forward earnings, if those earnings 2 years from now are maintained and we go ahead, we move the clock ahead 1 year, and the market next fall starts to look out to the following year, it's likely to pay 14 times. So I've paid 12 times what the 27 earnings are, and I've received 14. That is a source, it turns out, of a lot of great returns. We're looking for cases where they can beat the earnings and where the roll forward of the multiple is likely to expand. And the opposite is true as well, as if the multiple is likely to contract. If I'm paying 14, it's likely to go back to 12, which it's averaged over the last couple of years. There's a lot more risk to my investment. And they just did an acquisition that gives them bigger exposure to U.S. power and the power grid. Yes. Does that become a meaningful driver? Is like everybody's talking about that right now? Well, there's definitely, they say accretive right away. So that's obviously good. I mean, accretion, just for the layman, is basically your earnings per share go up from the deal. And that can happen a lot of ways. If I find out something entirely with debt, it tends to be accretive because all of the asset comes to you. You pay interest on the debt, but then I get all the earnings back to equity. So that's generally how accretion happens, is that you finance it with some debt. But in this case, there's some synergies right off the bat. And some, cost synergies. not to use the euphemism synergies, but oftentimes it's
Costs.
duplicative overhead. So you're going to cut staff or you're going to integrate staff. That happens when companies are acquired. But that's a source of why this is accretive right off.
Okay, so facing attractive markets and undervalued. Let's talk about GE Healthcare, which is your second pick, a spinout of the GE conglomerate, which is now 3 separate companies.
Yep.
Also a laggard, right? Down about 9%, underperforming the market. What do you see here?
Yeah, so we bought some GE last year in the middle of the year. Basically, there's some negative overhead here because of tariff risks, because of China, that really dragged down the stock. So people were worried. They eventually did make an arrangement where they're going to continue to sell in China, but through a third party. The Chinese market is a tough market to sell into, but these are a globally competitive brand. They're only a few competitors that do CAT scans, MRIs, all these machines that they make. Siemens, Philips. So they have a big market share. But really what we like about the stock is the fact that it's not hugely valued. And effectively, there's an opportunity here in this particular market to pair software and AI with the underlying hardware. And that can be extremely lucrative. If you think when you go in for a scan, you have a radiologist, high cost labor. Well, it turns out that AI can do a very good job on radiology. And so if you combine the software, the AI software with the hardware, suddenly you can sell a whole new generation of these scanners that have software as a service built into them at a higher margin. So this is something that GE Healthcare has recognized. They went and bought a Montreal-based company called Intelerad that packages together all of that AI software. And I think that's a long-term trend, but ultimately we think that undervalued, it's probably worth into the 90s. You're getting it around $80. So it's a good healthcare option.
Secret AI stock.
Yeah, more or less.
What about Brookfield Infrastructure? Can we call that a secret AI stock?
Well, they do have a lot of exposure to the build out of data centers and the utilities thereof. But all of their divisions are growing, actually. And what you're getting with Brookfield is kind of a growthier version of utilities. You get a nice yield, top line, or the free cash flow, what they call funds flow per share is growing up to 9% a year. So you're getting an underlying dividend yield, I think around 5% plus a lot of growth, and not a lot of risk. And it's a well-managed company. So,
when you go into restaurants and they have the grades the restaurant has passed and it's like an A or whatever, can we apply that? Because you know more about accounting than I think I ever will. People always talk accounting and Brookfield. Just don't go in the weeds with me. Just give me the grade level.
So Brookfield Infrastructure probably has the cleanest accounting of the Brookfield group. Well, let's put it that way. And that the Veritas research analyst, that's his one buy in the Brookfield space. They don't like renewables. They don't like asset management. They don't like Brookfield Corporation, BN. And that's a lot of that comes down to how the intercorporate arrangements are set up. But Brookfield's relatively clean. It's a group of assets. The assets are fairly transparent. We know you know what you're getting. And there's been a lot of capital directed to them that they can invest. And ultimately, I think that's the secret that Brookfield has that makes the secret sauce is that people are willing to give them capital as they can drink from the fire hose of capital from institutional money at very low rates. They're very good at reinvesting from those low rates and earning a return above their cost of capital. That's the secret. But it's a reputational secret because as long as people want to direct to those type of assets, so as long as they want to give you money, then you can get that low cost. But I think our argument has been on the other side of the businesses is that there's more inherent risk tied in with the underlying than people realize. There's private equity exposures, private debt exposures. There's all these things that are relatively opaque. And U.S. peers that do much the same thing don't have nearly the valuation that Brookfield, the main Brookfield.
But that doesn't apply to Brookfield Infrastructure.
No, Brookfield Infrastructure is a nice set of assets with predictable outlook that's growing, good dividend yield, and that's why we like it.
So it's funny, when we started this podcast, Sam sat down, he's like, well, I don't know if I can go an hour. I think we've answered that question.
Okay.
Thank you so much, Sam. It's been an absolute pleasure to hear how you think about stocks, and probably people learned a lot about stocks that are in their portfolio. They never even knew the nuance. So thank you so much.
Well, thanks for having me.